Venugopal Garre is now with us. He's a market master of the day, managing director, India head of research at Bernstein. Venu, good morning. Great to have you back on the program. Thanks very much. Venu and the team at Bernstein, of course, were one of the first who started cautioning about this, slowdown in growth momentum, business cycle momentum, risk to earnings, etc., etc. And all of that has played out, especially in H2 of FY25, starting, I think post-July, post-August or so. So, those things have panned out, and where do we stand now? Prices will move ahead of news flow and actual data, etc. So, is there any sense in trying to be slightly ahead? So, what I'm getting at is, if the slowdown, etc., is materialized, should we try and price some sort of a reversal at an underlying growth level, and then, of course, for stocks as well? Basically, start to dip your feet and start to buy stuff at the margin. Your thoughts?
Prashant, thanks for having me on the show. I think you have given a very good backdrop. I was about to say and claim some victory for last year's weakness in macro, but you've sort of laid it out for us. So just to put in perspective that my thinking is pretty much similar to what you're saying, that after being cautious last year with the 23,500 Nifty target, with the view that macro would weaken, earnings looked frothy with room for cuts and of course no upgrades, we are in a situation where to a large extent, in my view, macro has bottomed out. Bottoming doesn't mean that we are going to swiftly move up to an amazing economic story this year, but yet bottoming itself is a pretty interesting thing to watch, because when macro bottoms, you also tend to see incremental earnings risks also tend to reduce beyond what you would have already modeled, which is pretty much setting up you for a situation where in this weak phase, in my view, one should be buying stocks. So we've sort of reversed our stance of being cautious to not buying in general to a situation where we want to be a bit more proactively this year, especially in the first half when things are weak, to be buying equities. Target for the year is 26,500, which is 12% or returns at a Nifty level. It's a good enough return in my view.
Okay, all right, Venugopal. That's really good to hear. So good, good start to 2025 then, because you've been, of course, one of the more cautious voices on the street for the better part of 2024. But I mean, we've heard everything you've said. You're saying that macros are bottoming. This is the time to go out and start buying stocks. So let's get straight to it. What's the construct then? If you were to create a fresh portfolio right now, I mean, what would get top billing?
Yeah, so, the way it works is the ways to play through the year will change. In terms of the sector construct that we have today, 3 months later will be different. But the idea is that at this juncture, we are overweight financials with a slightly lower weight than we had last year. And the idea is that macro bottoming out and recovery is still a 2-3 quarter process. So we're going to probably strengthen our weights on financials through the year. But at this juncture, we're overweight financials. IT services, we've actually increased weights. If you look at any near-term damage that you see from an economic standpoint, being exposed to potential positives coming in from US, rupee depreciation, which is already played out to some extent, but rupee is still a bit overvalued. So to the extent you still have some depreciation tendency left, IT services probably is a much better way to play that, given that we are moving off a relatively lower growth phase of last 3 years to maybe an okayish phase. So that's like the trend line. We also decided to upgrade utilities to overweight. The idea out here was that it's relatively more safer and calmer as a space, and you'd have seen the damage in terms of stock prices last year, especially in the second half for utility stocks. Telecom is an overweight for us, but that's a continuation of last year's overweight. There are various ways to play that, but the reality is that it's a relatively more steady annuity sort of a business, which is not really too impacted by macro in a major material way. I would probably say that these are the ways in which we are sort of playing. We are still sort of neutral-ish on consumer, even though we upgraded consumer staples from an underweight to sort of equal weightish per se. And the sectors which we still don't like are sectors like industrials, where we think that they're still overvalued. And the better way to play that is through utilities.
Okay. Hi, Venu. Good morning and good to see you in. Wishing you all the best for 2025. You've given us the upside target, 26,500, give and take everything. You're still factoring in a 12% increase in this year on the Nifty. But I think given the current market construct, the street would like to know what is the downside risk as well. On the downside, where could we visit? If you could give us a level out there, point number one. Point number two is on earnings. Clearly, the street is very, very nervous with regard to earnings growth. And it appears FY25 is going to be a weak one. But all hopes are on FY26. So what are you all factoring in terms of earnings growth? Downside as well as earnings growth. Please go ahead.
Yeah, so first, let me give you the earnings construct. Look, we all have data. We all know what's going to happen in the near term. The earnings picture is not that great for FY25. First half of the year, we were close to flattish, especially for large caps in terms of YOY growth. Second half, there's an expectation of 15 to 18%. Highly unlikely that we achieve that sort of a big lift YOY. So what it means is for the full year, you end up at sub 10% sort of numbers from a growth standpoint. But as we sort of look at the broader thinking about economy itself bottoming out, and there are a lot of things which did not play out last year. For example, capex did not play out last year. Consumption was, in general, fairly weak from a YOY base perspective as well. These are the things which would start to pick up in the financial year FY26, which is somewhere 2 quarters from now, which is where for next year, we would probably be of the view that they would be relatively better earnings growth compared to what we've essentially seen in FY25. Now, from a next 2-year perspective, my broader macro forecast is for a 6.5% plus GDP, and not the 5.5% that you see in that you saw in the previous quarter. So to that extent, as you start to see economy inch up above 6.5%, my broader thinking is that getting a 12% plus earnings growth on 2 consecutive years is not necessarily a very big feat. Even in a phase of 10-year of downturn that India saw, we saw 7-8% earnings growth. So 12% in a situation where you're going to see macro recover is a good enough possibility. So that's what we are essentially modeling. And if you see, we're not really building in re-rating for the price to earnings, and that's the reason we've got a very similar market returns target as well. The second question is more on downside. I guess I personally tend to play a lot when I take market calls on sentiment. Sentiment last year, mid of the last year, was exceptionally strong, and that's why I was very negative. Now, I actually think that sentiment is very negative at this juncture. Everybody is aware of the risks, the worries, currency, Trump, what could happen to macro side, will government actually accelerate capex and things like that. So I guess the way to look at that in terms of modeling is very simple. Last 10-year, Nifty probably bottomed close to 17x in terms of 2-year forward PE. And even if we assume somewhere in the 7 to 8% sort of earnings growth, which is usually in bad times, somewhere around 22,000 or below is like more or less the hard bottom for Nifty. Now, that's not really far away.
Okay. Got it. Venu, one more quick point. We're looking forward to some kind of support, both policy support as well as monetary support. The RBI, what are you all factoring in terms of their action? As you've mentioned, this is the longest phase that you've gone without seeing a rate cut. I think close to around 700 days, which is even longer than 2004. So how many rate cuts are you all factoring in from the RBI?
Cumulatively, at the bare minimum, 50 basis point is a likely possibility that we see. Remember, the policy challenge is the fact that rupee is depreciating. And rupee, in our view, based on the broader metrics, is about 7 to 8% overvalued at this juncture based on where other currencies are, where US rates are, and other things. Of course, that overvaluation could moderate over time when the market realizes that probably Trump's actions may not be as inflationary as you're already assuming today. So to that extent, the room for rate cuts could be higher than 50 basis point. But remember, it's not going to be a first half driven sudden cut in rates. I don't think RBI can manage the currency spiral that easily. So think of it as more as very minimum 50 basis points. And I do believe inflationary risks are much lower than what people believe.
Got that. Venu, one line in your report kind of stands out. And I think you're being tongue-in-cheek there, right? You say domestic flows have so far been immune to fundamentals, but it's the backstory. It's not exactly looking ahead. But I think you say that it seems they're investing for India 2,280, while low-quality IPOs continue getting attention.
Yeah.
It was from the heart, Prashant. It was an emotional gesture when I wrote that report. But that is the reality. I mean, let's be very practical about it. I look at India year to year, maximum a 3-year bucket. Who knows what's going to happen in 2040? And the reason I wrote that is because whenever I argue that SMIDs are in a bubble, I get sort of a pushback that India is going to be the largest economy in the world in 50 years. There's so much amazing growth story left. I think that's just storytelling. Nobody knows what's going to happen after 3 years. So this was primarily directed at that set of sort of commentary or investors or the feedback that I get.
But it is also true, while we keep that skepticism, for people who can invest in India and our investors, I mean, they must believe, right? I mean, that's the first step. But
you don't need to believe in a 50, 75, Prashant, you don't really need to believe in a 50-year story. Honestly, we don't even know the shape of India 50 years from now. But the fundamental reality at this juncture is that the first stage when you actually see, let's say, 2-3 years of massive macro collapse, you're not going to be talking about, India great story at that point of time. Fortunately for us, we are in an early cycle. That's why I don't really see those risks playing out over the next 2 to 3 years, where we have to basically scurry and worry about big collapse in the markets, right? So that's the only aspect I would say. But I don't think you should mask your near-term 1-year, 2-year views with 50-year stories.
No, absolutely, Venu. I'm glad you say that because there are analysts on the street who do write, of course, for the very, very, very long term. But I guess you, keep it more real. Just to wrap this up, so I'm just summarizing everything once again. Basically, you're saying it's the time to be cautiously optimistic. You're expecting a 12% index return this year, right? And what about earnings? What's your final number for FY25? And more importantly, FY26, what's the kind of earnings growth you're penciling in?
In a very simplistic way, think of, when I say earnings growth, is typically I talk for Nifty 50 rather than for the overall NSE 500. Because NSE 500 will be, mid caps will have higher earnings growth than large caps, but Nifty 50 is somewhere in the 8 to 10% range for this year, 12 to 13%-ish for next year, another 12 to 13% for FY27. So over a 2-year period, from the next financial year, it is basically somewhere in the low to mid-teens. That's like the broad number that I'm working with.
All right. Okay, Venu, we'll leave it on that note. Optimism is good. And to get that from someone who's been very cautious in the market for the better part of, the second half of 24, a very, very interesting call. And we'll hold you to it, of course. Thanks very much. Have a great year and look forward to more conversations. But